If you're buying a rental property, should you put it under your personal name or a holding company? What's best for taxes? Which one gives you more benefit? And most importantly, which one helps you keep more money in your pocket? This is one of the biggest questions real estate investors ask. And today, I'm breaking it down in the simplest way possible. So let's get into it. If you are new to my channel, my name is Jazz O'Brien and I'm a real estate agent, investor, and a serial entrepreneur. I went from working as a server to owning multi-million-dollar worth of real estate portfolio in just 8 years. In my career, I have helped hundreds of my clients buy over 900 million worth of real estate using tried and tested strategies, and I am here to share those tips with you on this channel. Huge disclaimer. Before we dive in, let me be very clear. I'm not a tax planner or an accountant. This is purely based on my personal experience as a real estate investor and is only for educational purposes. Everyone's financial situation is different, so before making a decision, always consult a qualified accountant or a tax professional to figure out what works best for you. Personal name versus holding company. When buying a rental property, you have two main options. Number one, buying the property under your personal name. Number two is buying it under a holding company. Each option has its own pros and cons, and the right choice depends on your long-term strategy. Do you want to sell the property in few years and cash out, or do you want to keep reinvesting and build wealth over time? So let's break it down so you can make an informed decision. Buying under personal name. Let's start with the most common route, buying a rental property in your personal name. One of the biggest advantages of personal ownership is simplicity. No extra paperwork, no corporate setup, and no additional legal or accounting costs. Another major benefit comes when you sell the property. In Canada, capital gain tax applies when you sell any investment property. But here's the good news. Only 50% of your capital gains are taxable. For example, let's say you sell your rental property and make a $500,000 profit. Since only 50%, which is $250,000, is taxable, and if you are in a highest tax bracket, which is around 53.5%, you will pay around $133,000 in taxes. Now, another advantage of buying in your personal name is easier mortgage financing. You typically get better interest rates and more flexible loan terms compared to buying under a corporation. But there are some downsides too. First, your rental income gets taxed at your personal tax rate. If you already have a high income, that your rental income could be taxed up to 53.5%, which eats into your profits. Second, liability is all on you. If your tenant sues you for any legal matters, you are personally responsible, and your other assets like your home, your savings could be at risk. Buying under a holding company. Now let's talk about buying under a holding company and why many savvy investors choose this route. The first big advantage is liability protection. If the property is owned by a company, any lawsuits or claim goes against the company, not you personally. Your personal assets stays protected. The second major benefit is tax deferral. When you sell a property under a holding company, you pay less tax on capital gains compared to personal ownership. The company pays around 27% corporate tax on the gain instead of 53.5% on a personal side. Another key advantage is mortgages under corporation don't always show up on your personal credit report. This means your personal debt to income ratio remains unaffected, allowing you to qualify for more financing in the future. This is why savvy investors use holding companies. They don't just buy one rental property and stop. They use the tax saving and financing flexibility to scale their portfolio and reinvest profits instead of paying massive tax bills every year. But of course, there are some downsides also. First, there are extra costs. You need to incorporate your company, file corporate taxes, and then you pay the accounting fees to keep everything smooth. Second, while the company pays a lower tax on capital gains and rental income, the tax impact comes when you withdraw the money personally. So if you take profits out of the company, you will first pay corporate tax, which is around 27%, and then you will pay dividend tax on top of that, which is around 30 to 47% depending on how much you're taking out. So if you plan to sell and cash out, personal ownership might be a better move. If you plan to reinvest and keep growing, the holding company structure can save you tons of money. What happens when you sell your property? Let's look at a real example of what happens when you sell your rental property under each structure. If the property is under your personal name, you sell and make a $500,000 profit, you only pay 50% of that as a taxable amount, which is $250,000. If you are in a high tax bracket, which is 53.5%, you will pay around $137,000 in tax. If the property is in a holding company, the company pays only 27% corporate tax on the gain first. If you leave the money inside the company, that's all you pay. No additional tax. But if you withdraw the money personally, you pay dividend tax on top of it, which is around 30 to 47%. The key takeaway here is holding companies are great for investors who reinvest their profits, while personal ownership is better for those who plan to sell and take out the money out sooner. So like you buy one property and after that you never buy any other properties. Then your personal side is better. What's the best choice for you? So here's how you decide. If you want lower taxes when selling and fewer admin costs, buying in your personal name is a simple and effective choice. If you want to pass less tax on capital gains, keep growing your portfolio and reinvest your profits, a holding company is a smarter choice. This is a route savvy investors take because they keep reinvesting, avoiding personal debt, and use tax-efficient strategies to build long-term wealth. At the end of the day, guys, it all depends on your personal goals. If you are thinking long-term, setting up a corporation might be worth it. If you are just buying one rental property and may sell in future, keeping it personal could be easier and more tax-efficient route. Again, talk to your accountant or tax professional before making your final decision. It could save you hundreds of thousands of dollars in your long-term run. I hope this breakdown helped you understand the difference between buying in your personal name versus a holding company. If you got a value from this, make sure to like and subscribe for more real estate and investment insights. And I would love to hear from you. How are you planning to structure your next rental property? Drop a comment below. And if you are serious about growing your real estate portfolio the smart way, let's have a coffee and talk strategy. The link to book an appointment is in the description. Looking forward to connecting with you. See you in the next video. Take care.